Where we are today. All right, let's keep going then. Where we are today, again, going back to the economic and financial indicators, looking at January 2021. Again, we're looking pretty nice right now, or at least in January. This is 1 year later after things have kind of fallen off the rails and then got back on. But it looks good looking in January. You take a step forward to April, and oh my goodness, Rocky, when was the last time you saw that chart where it was all green except for 3 yellows?
Yeah, that's interesting.
Well, it is.
That's a long time.
Yeah, I don't know the last time I've seen that. You know, you could probably contribute the geopolitical risk going yellow to all the peace deals that went on the last couple of years in both Europe and in the Middle East, because you get the Middle East stabilized, the geopolitical risk goes down. So there is that. The political environment, I don't know what's going on there, but it's yellow right now, and we're looking pretty good moving forward. So let's take a look at some of the conditions that we think are really going to be favorable for this market and the economy moving forward. First is, well, you look at the low interest rates, you look at the high liquidity level, you look at the accommodative monetary policy that the Feds have given us, you look at the fact that the businesses are able to access finance cheaply and relatively easily. Well, what does that say? It says that at the end of the day, there is room to run. If you look at the St. Louis Fed Financial Stress Index, it was pretty high in April of 2020. You look at it now, it's pretty low. So we've got a lot of room to run up in this market in the near term for sure going forward. Money on the sidelines, this is another one. Money on the sidelines doesn't stay on the sidelines for very long. People want to incorporate it into something that's going to move them forward. So you've got 2 lines here on this chart, and it's the household net worth and the corporate cash. The corporate cash, we'll look at that one first. That's the blue line. It's only been higher than where it is right now, looking at this chart about a month ago. It is really doing very, very well. The corporate cash structure, they've got money, they just need to deploy it, and they will. You look at the household net worth. Well, you go back to 2016, the household net worth has been increasing year over year over year. You've had a couple dips in there. You had one at the end of 2018-19. You had one from the COVID crisis, but it has never been higher. So, you know, this isn't just the wealthy high net worth or people. It is everybody. You know, the old saying, a rising tide rises all ships, is no truer than here. So you've got people in poverty that was lifted out of poverty. You got people that were lifted out that came up a little bit higher. Your middle class has gotten better off for the first time in many, many years. And then obviously you're going to have wealthy people get wealthier as well. But at the end of the day, everybody got lifted up. So that's an awesome thing. The other part is pent-up demand. You know, if you think about it, most of us have been locked up so much, we want to get out. I mean, when was the last time you went to a movie? Rocky, when was the last time you went to a movie?
It's no black and white. I can't.
Well, mine were the talkies. Yeah, it's been a long time. So think about it. The 2020 average spending versus the pre-pandemic, transportation and warehousing, well, that's down 44%. Arts, entertainment, and recreation, that's down 47%. You look at the accommodation and food service, that's down 33%. What do you think is going to happen with all this pent-up demand? It is going to rise. So this is going to be another part that's going to boost our economy. With all that good news, we can't be chasing after things in the market. And this is so important. So when you think about chasing last year's winners, it can be a very, very hard losing game. And all you have to do is look at this chart where it shows emerging markets, international, US high yield, all the way up to US equities. And it has a key on the right-hand side. So let's just take a look at US equities, which is the dark green. Now, if you think about it, in 2015, if you would have said, well, you know what, 2014 and 2015 were really good, I'm going to jump everything into US equities. Well, the US equities dropped down to third place at that point. Okay. Well, what if you were in 2011 and you were in US bonds? Well, I was at the top of the ladder. They did so well that year. Let's do it again this year and put everything in US bonds. Well, in 2012, where did they go? They were second from the bottom. So what this chart tells you is you cannot predict from last year's winners who this year's winners are going to be. That's why diversification is so important within the portfolio. So never run after last year's winners, because it can very well be a losing proposition. So diversification is the key. When you look at this chart gives you really the global equities and the global bonds. And think about it this way. If you were never in global equities and never in global bonds, would your portfolio have been helped or hindered? Well, when we're looking at this chart, it really depends on your risk tolerance. If you were a full equities person and you ran into this crisis, your account would have been down significantly, but it would have bounced back relatively quickly. And if you were looking at it at the end of the year, you would have been ahead, but you would have had a lot of volatility. If you were a mixture of global equities and, let's say, global bonds leaning to the bond side, it wouldn't have gone down as much, but you still would have had a decent end of year within that portfolio. So you can navigate volatility just by adding diversification within your portfolio. And nowhere is that more evident than the global market. All right, where are we right now from a valuation of the S&P? So the S&P forward price earnings ratio. You can see if you go all the way back to 1999, how overvalued things were back then. That's when the tech bubble broke and everything just kind of fell apart at that point. Well, you can see now that we're still within the fairly priced range, and actually better off today than we were a few months ago. So we are not overvalued. We still have room to run down this track to the end of the year, to where we believe, again, the S&P should be up somewhere between 8 and 10% by year end. Now, that's obviously, you got to take a look at if there are any black swans that occur. What's a black swan? Well, just look back to March of last year. That is a black swan, something that nobody anticipated. But short of that, we think we're going to have a pretty decent end of year. Could be volatile, but we're going to have a pretty decent end of year. That being said, I'm actually going to pass it over to Rocky, and Rocky's going to run us down to where we are today and moving forward, and what we seem to think, or what the stats are telling us where we should have.
A little bit of forecasting. So here's where we think we're going to be going. Okay. What I want to show here, and you're not expected to be able to read these. I know these are a little smaller, but what we did is we put 3 different charts on the same page. And what we're seeing for 2021 is probably one of the strongest recoveries we've seen in the last 40 years. The top chart is retail sales, the bottom left, building permits, and bottom right is manufacturing. When you look at each one of these areas, we're seeing strength that's coming from consumer spending, from the housing market, and manufacturing, and we believe that trend is going to continue. It's going to continue to be very strong throughout the second half of this year and into next year. When we look at job recoveries, the slide on the left shows that 63% of the job losses have been recovered going into the first quarter of this year. Now there's still an $8 million or 8 million job shortfall, people that haven't gotten back to work yet. But if you look at the chart on the right, because the economy is opening up, more companies are being able to get people back to work or bring new workers back into the workforce. The number of new job openings is trending higher, and that's what you see in the bars on the right side. Those gray bars are continuing to go up. That is not employment, that is job openings. You have to have jobs for people to go back to work. So if the job openings are increasing, the opportunities for people to get back to work are increasing, and that's what we're trying to show here.
Well, you know what's interesting, Rocky, on that slide is and this is something I would tell everybody out there. If you know someone who is on unemployment and they have the ability to get back to work, I would encourage them, get off unemployment, even if they're making more, and get back to work. Because my concern, and a lot of business owners' concerns right now, is that the people who come back are going to be the cream of the crop. The people who really didn't come back or not trying to get back to work, they could be left on unemployment because the business owners, there is a trend to cutting back a bit and getting more lean and mean again, just like they did in the tech bubble crisis that we had.
Yep.
So I would encourage people, even if it's a short-term loss, to get back to work, because the jobs are not going to be there the way they were prior to this pandemic.
Yeah. The thing I think of too is unemployment doesn't pay any health benefits. You got to get back to work to protect your family.
That's right.
So anyways, on to the overall market. What we're seeing in our forecast for the year is, when you look at the left side, this side is representing equities. Where do we see the growth opportunities in equities? In U.S. growth, in dividend and income stocks. Small cap is the largest. The bar is not showing up well there because the color didn't come through. The only place we're seeing a downside is the developed European markets. And again, part of their problem is COVID has really not been decreased like we've done it in the United States. Emerging markets, we're expecting a great amount of return in this year because they went so far down. And the fact that the U.S. economy is strong and consumer spending is strong, that bodes to help with the emerging Asian market too. When you look in the center of the chart, the core fixed income, taxable and tax exempt bonds, not going to produce a whole lot. Okay, why? Interest rates are rising, so the value of the current bonds out there aren't going to bode as well. Where's the opportunity? We see that more in what we call the high yield market, which is the green section, opportunistic fixed income. So that, because the Fed came in and they actually supported by buying bonds last year, we see that there's going to be opportunity in higher risk bonds. Again, remember what I'm saying is higher risk. So the volatility may come with it too, but the opportunity on the fixed income side is going to be in those higher risk type bonds. And then alternative investments. Alternatives can be private placement, equity, real estate, and things along those lines. Maybe even some commodities, gold, silver, things like that traditionally do well in rising interest rate environments. And then what do we assume for a balance or project for a balanced portfolio? 60% equity, 40% bond. That's that black bar. So we're looking at a 6 to 8% potential return by the end of 2021 in that type of portfolio.
Now that would be a gross amount, right?
Yes, that's
not,
a gross amount.
Not a net of fee and expenses that you have.
Right, these are just pure numbers based off of market indexes. So next section, we're talking here on this slide about where the focus is. Now remember, I told you earlier, the Facebook, Alphabet, Netflix, Amazon, Microsoft, Apple, those companies drove the market gains last year. Well, that shift has already started taking place where we actually saw the NASDAQ in the first quarter of this year take about a 15% hit. It actually went down, while the Dow and the S&P continue to be stable or slightly moving forward. So there's a sector shift in the market away from the high growth, high tech, back into more your stable companies. And who is it representative of things like that? That would be like your Johnson & Johnson, right? Your Coca-Colas, your big companies that are big international companies, but they're more consumer product oriented. They're not tech oriented. So this is basically talking about, we don't want to be over speculative going into this year and next year. We want to go back to more traditional dividend type growth companies and things like that. So that's where we're making our focus. Again, high dividend stocks relatively to growth stocks have not performed as well the last couple of years. And thus we shifted away from that into growth. But that trend we believe is going to reverse. What do we want to buy? We want to buy stocks that are low priced, that are valued priced right now. They're not overly expensive. So we're making this shift in the portfolios away from growth. Not that we won't have any growth, but shifting it more to a balance of bringing in the less expensive high dividend stocks back into the portfolio, because that's where we see the opportunities moving forward. When we look again at the fixed income side of it, the blue lines represent the high yield market, where the yellow represents the investment quality grade bonds. Again, like we talked a couple slides ago, the opportunity is going to be more in the riskier section of the bonds moving forward, as you can see in these charts. So that's what we're projecting. We're bringing more of a balance of high yield into the portfolio, less treasury, less corporate grade. So that's where we're going to get the return from over the next year to 2 years. Another problem that kind of still exists out there moving forward, and why inflation is being talked a lot about, but why it's not a big concern, is because we're not seeing inflation in all areas of the economy. We're seeing a big imbalance depending on industries, depending on the types of products and services that they offer. So when you look at the chart on the left, basically what you see is that the Fed has a target. It's the gray flat line. The Fed wants to target about a 2% growth or inflation rate. And that's measured by the core price index here, which is the black line, which has been very jittery, very up and down since 2000. But their target is about 2%. Historically, since 2000, we've been running about 1.7, 1.75, which is the dotted blue line. And you can see we are well under the targets. So even if inflation is coming back and moving up, we don't see that as a problem over the next year or so. And that will bode well for growth in the stock market. When we look on the right side, we see that paper products, used cars, and cleaning products, obviously, right, with COVID, cable and satellite TV, eating at home, those have kind of gone up quite a bit year over year and have been inflationary. Yet when you look at other parts of the economy, airlines, hotels, public transportation, clothing, those things are down and significantly down. So we're not having inflation across the board in the United States. This chart is really kind of cool. You don't have to get into the details. I'll tell you overall what's going on here. These are 13 different inflationary periods in our economy. What I want you to focus in on is the right side and whether the S&P during those periods actually gained money or lost money. And you can see only 3 periods out of the 13 with rising interest rates did the S&P actually go down. Because we're at historically low rates, and just the fact that interest rates are going up doesn't necessarily mean that's bad for stocks. That can still be a bullish sign because it actually is saying the economy is stronger. As the economy gets stronger, the Fed's going to raise interest rates to keep it from getting out of hand. So you can see historically here, we believe that we're still in a very good position even if interest rates trend up a little bit moving forward. However, in a rising interest rate environment, we also expect to have increased volatility. But when you look at the volatility over this chart here, starting in 1980, the black or blue lines, depending on how your screen is showing it, represented how the S&P ended up for the year. So most of the years, you see the black lines are above zero. So we had many, many more years of positive returns than negative returns. However, the red dots or squares represent somewhere in that year how far the market was actually down. And you can see pretty much year by year, sometime throughout the year, the market was actually down. So if we go into a period where in June or July, you see this market correct and goes down, don't worry. We see the long-term trends. We will readjust the portfolio if that happens. We will rebalance for it to come back. But we expect the trends long-term to be up this year going into next year. One of the reasons we believe that, and that's going to stay on that trend, is because Fed policy, they're projecting keeping interest rates significantly below average over the next 3 years. I mean, they have a personal interest in this too, because this also applies to the interest rate we're paying on the debt. So if we don't have to pay a whole lot of interest, it's easier to pay down our debt over time. Okay, so that's one of the strategies they're wanting to employ. Raise taxes, but keep interest rates down so that we can get the debt back under control over time moving forward. But this picture, the Fed taking a low interest rate approach to the future, bodes well for companies as they borrow and try to expand. So we see that being a long-term positive trend for the stock market. Again, here we are expecting multi-year expansion, even if taxes go up, because we believe that there's enough with low interest rates that corporations can borrow and continue to invest in the growth of the economy moving forward. And the consumer is right there, as you can see in like the housing market and things like that, that the consumer is willing to spend. So that is all boding well. The GDP projection for this year, on the right side, you see for 2021, between 5 and 6.5%. I personally believe it's going to be closer to that 6.5%. Okay, next year, it's going to normalize a little bit, somewhere between 2.5 to 4.5%. But if you look down at the chart below, basically GDP growth of 2% to 2.5% is pretty normal. And we've had great stock market returns of 6 and 7% in those years where growth has only been 2.5, 3%. That is still solid growth for the United States, but it could be as high as 4.5 in 2022. Corporate profits, this year we're expecting 25 to 30%, because again, the economy is getting back on board and getting back to more normal. So during that process, obviously, they're going to do better than normal to get back on track. Next year, 2022, we're expecting 10 to 20% potential profit growth for corporations. Again, bullish, very bullish for many years moving forward into 2022. Fed's fund rate, they said they're going to keep it low. Interest rates, as a result, will remain low. So all these play into the factor that we believe going into 2022, things look very, very solid for maintaining our portfolios.